Hello, everyone. You're now tuned in to the Millionaire Millennial. I am your host, Stack Banks. Ooh, I'm messing with my camera here. Um, Today, I'm filming inside of my apartment instead of going to the office. You can't probably tell, but it's pretty gloomy outside, and I didn't feel like driving in the weather. But this is the 18th episode, and there's a lot of exciting stuff to talk about. Normally, we try to keep these episodes about 20 minutes long. We might run a little bit over today, but there's some exciting stuff going on in the financial space, and I want to keep you guys abreast of it. So we've missed a couple episodes. Usually we do it bi-weekly. Over the weekend, I didn't get one out. Normally they're Monday and Friday. Then usually by the weekend, if I don't have them out by Friday, I have them out by Saturday. But I had missed, I believe, an episode last week. So for those of you who do follow religiously, which at the moment there's not that many of you, it looks like my YouTube reels are actually the biggest thing going at the moment with the most views. So YouTube, shout out to you guys. But for those of you who do follow along and expect these episodes on a regular basis, I'm sorry if they don't come with the frequency that I promise you guys. But what I want to talk about today, huge news going on in the financial sector, both in the Web3 space, in the stock market, and specifically for retail investors, aka the average Joe, more than likely you guys. So we're going to talk about it. Excuse me. So number one, before we even get into it, I do caution you guys: this is not financial advice. This is not investment advice. Please do your own research. Look into everything that I talk about. If it's something that you're thinking about putting money into or taking money out of, please be informed. This is all just sort of a starting point for you guys to do your own research, and hopefully it's a benefit and education to you guys. So number one, let's get right into it. Big news talking about the stock market. I'm going to read you guys a blurb from investors.com. So the Dow Jones Industrial Average closed lower Monday while trading in Berkshire Hathaway. Eventually restarted after being halted amid a plunge rate. So those of you who don't know, Berkshire Hathaway is the company ran by Warren Buffett, one of the richest people in the world. I should have actually pulled it up, his net worth, but Warren Buffett's personal net worth looks like sits right around $137 billion United States. That's of April 2024 United States dollars. So I believe him to be the third or fourth richest, or no, he's the seventh richest man in the world at current moment. So Berkshire Hathaway, stock trading was actually halted. So I'll read you this. The Dow Jones Industrial Average closed slower Monday while trading in Berkshire Hathaway eventually restarted after being halted amid an alarming plunge. The NASDAQ composite closed higher on the stock market today as NVIDIA popped on the release of more artificial intelligence products on the weekend, and GameStop closed 21% higher than it had previous. Sorry, I'm misreading that, but had closed 21% higher. So we'll talk about Berkshire Hathaway because this is something that, for those of you who do invest, whether it be through traditional investment markets, through like mutual funds, things like that, or you have a money manager or something like that, you might not be as informed of these things. But those of you who use things like Robinhood, Coinbase, things like that, and are in charge of your own personal stock portfolios, be aware that when you use this technology, even these massive companies are not free from having technical issues, right? And if you are someone, I'm not telling you watch stocks religiously, or the prices on certain tickers, or whatever, but things do happen, and if you can capitalize on it, you can make a lot of money. And I don't know if those who had capitalized on the fall of Berkshire Hathaway's stock price over this time during this technical issue that that the New York Stock Exchange was having, but or if people are going to be forced to pay the actual price or give back the stock, I don't know exactly if there's a resolution to it in that regard, or if it's just going to go through as a completed trade and it is what it is. But for investors that might have made off with them, I mean, a Berkshire Hathaway share price, I believe, as of today, is somewhere in the neighborhood of like 630 some odd $1,000. So I'll tell you guys exactly what happened. Trading was halted amid technical issues at the New York Stock Exchange. Barrett Gold and Warren Buffett's Berkshire Hathaway were among the equities affected. And a New York Stock Exchange spokesperson had said a technical issue involving industry-wide price bands published by Consolidated Tape Association Securities Information Processor triggered limit up, limit down trading halts on up to 40 symbols listed on the New York Stock Exchanges. Shortly before noon, the issue was resolved and trading in the impacted stocks resumed. So at that point, Berkshire Hathaway's stocks fell by 99.9%. Trading was halted when the stock was quoted at $185.10 compared with Friday's closing price of $627,400 per share. Okay, so that would be roughly a discount of $627,200 on a stock. So if you could have bought it for $185 and 15 minutes later it's worth over $600,000, that'd be a pretty good investment, I would say. So that was a technical error that had happened. And then for those of you who do know or have some understanding or have heard of the company NVIDIA, they're an AI chip processing, computer chip building company that's based in Taiwan, I believe. So their stock price has been on the climb recently at an astronomical rate. Their price roughly, I believe, around close to almost $1,200 a share. And they went up another 5% amid NVIDIA's chief executive, Jensen Huang, talking about their future AI chips. And he had talked about that on Sunday. So the stock is extended. It says, let's see here. I'm trying to see if there is an actual overall percentage from the start of the start of the beginning price of the stock. I don't have that information readily available, but it's a fairly young company. I do know as of February in 2024, so roughly about 4 months ago, the same stock price or the same stock was trading for about half the price, for roughly $660. So it's looking at almost $1,200 as of today. So they're doing amazing. I would assume most people would expect them to do well as time continues on, especially with the big advancement in AI that we've been seeing, especially in 2024. But even in bigger news, GameStop, some of you may or may not have heard of it, but it's a public traded company where essentially video games, physical copies of video games and assorted merchandise and things like that are sold. Physical locations, usually in standalone locations. They're usually in strip malls around the United States and the world, but in malls as well. And with, the advent of streaming and downloading of games, they have not been doing well, and they're not expected to do well, especially, post-COVID, where a lot of people aren't going into stores anymore to buy physical copies of things, especially their games, when they can just download them directly to their console or their PC. And that had created quite the controversy back in 2021. And I'll break that down a little bit more for you guys here in a little bit, but I'll read you what investors.com had said about it. So they had said GameStop had soared but ended off well, or excuse me, some of the that's some other things too about journalism that we got to talk about, the standards of journalism. The amount of typos I see in printed media nowadays is insane. I think the editors of old would have lost their minds. And I do not have a journalism background, but I'm 35 and I'm old enough to have read a newspaper and remember a time before the internet as we know it and before blogs as we know them. And I got to say, print media, you guys got to step it up. Spell check is free. Anyways, so it says, meanwhile, GameStop soared but ended well off highs as Reddit investing personality, that's what they're calling him, Roaring Kitty, that's his Twitter handle and Reddit handle. Actually, I believe his Reddit handle is Deep Fucking Value, but the guy's name is Keith Gill, and in this article, it's quite biased. I mean, I can tell from just even the way they phrase some of this stuff, but they call it and hopefully some of you guys are informed about this, and I'm not butchering the subject too much for you, but they call this stock a meme stock. It's not a meme stock. It's a stock. It's the GameStop stock. And I don't know who owns or pays for investors.com, but I like this small segment because it's written in a concise manner. I don't think necessarily that they're being 100% honest about the way that they're writing it, but I'll read it as is, and then we'll dive into that. So it said, Reddit investing personality Roaring Kitty disclosed a large stake in the meme stock. Meme stock mania was back in full force Monday after influencer Keith Gill, known as Reddit investing personality Roaring Kitty, shared a social media post that showed a seemingly substantial stake in GameStop. GameStop closed 21% higher. Fellow meme stock they call it's not a meme stock. AMC Entertainment also saw early pop fade as it gained 11%. Okay, let's hang on one sec. Michael Larkin of investors.com is the journalist who wrote this. I'd like to I think he's not being completely genuine about the way that this was written. And I had read this earlier, and these didn't quite stand out to me until I started reading them out loud. But these are not meme stocks. Don't get that confused. There's no such thing as a meme stock. There's meme coins. There's shit coins. Those are things within the crypto community that people talk about and have a legitimate basis for that name. In the stock market, there's no such thing. There's no listing for meme stocks. There are stocks. Okay. He's calling this a meme stock because of the retail investment interest. And I think there's clearly an agenda behind this article. I hate to break it to you guys, but we're just going to use the information that's in this article. We're not going to necessarily talk about the bias that we see within it. So let's draw some things out of that, right? So basically, GameStop is up 21%. Okay. So for those of you that don't know what the big deal is with GameStop, or maybe you've heard about it, or you've heard of Roaring Kitty or Deep Fucking Value or DFV, as I'll try to refer to him the rest of this episode. But we're going to talk about what's been going on with him and what's been going on with this whole GameStop thing. So in 2021, a short squeeze of the stock market of the American video game retailer GameStop and other securities took place. That's what they're talking about, like AMC. And it caused major financial consequences for certain hedge funds and large losses for short sellers. Okay. Approximately 140% of GameStop's public float had been sold short, and the rush to buy shares to cover those positions as the price rose caused it to rise even further. The short squeeze was initially and primarily triggered by users of the subreddit r/Wall Street Bets, which is an internet forum on Reddit, for those of you guys who don't know, which is a website. Although a number of large hedge funds also participated. At its height, on January 28th, the short squeeze caused the retailer's stock price to reach a pre-market value of over $500 per share USD, nearly 30 times the $17.25 valuation at the beginning of the month. The price of many other heavily shorted securities and cryptocurrencies had also increased. So this was during 2021. I remember this. Um, some of you may or may not, and some of you may know the movie Dumb Money. I believe it's on Netflix. If you haven't watched it, check it out. It goes into it and it talks specifically about this, right? And that might bring you guys up to speed. Okay. So on January 28th, some brokerages, particularly app-based brokerages, such as Robinhood, and I'm reading this directly off Wikipedia, you guys. You can look this up yourself. This is not my personal opinion. This is, for the most part, pretty cut and dry what happened. Um, Robinhood halted the buying of GameStop and other securities, citing the next day their inability to post sufficient collateral at clearinghouses to execute their clients' orders. This decision attracted criticisms and accusations of market manipulation from prominent politicians and business people from across the political spectrum. Dozens of class action lawsuits have been filed against Robinhood in U.S. courts, and the U.S. House Committee on Financial Services held a congressional hearing on the incident. The unusual high price and volatility continued after the peak in late January. On February 24, the GameStop stock price doubled within a 90-minute period and then averaged in the neighborhood of $200 per share for another month. On March 24th, the GameStop stock price fell 34% to $120.34 per share after earnings were released and the company announced plans for issuing a new secondary stock offering. On March 25th, the stock recovered dramatically, rising by 53%. Okay, so what does that mean, right? And why? And this is what we're going to go into. So I had mentioned earlier approximately 140% of GameStop's public float had been sold short. So what is public float? So public float in the context of stock markets, the public float, or what can be called free float, represents the portion of stocks of a corporation that are in the hands of public investors, as opposed to locked in shares held by promoters, company officers, controlling interest investors, or governments. This number is sometimes seen as a better way of calculating market capitalization because it provides more accurate reflection than entire market capitalization of what public investors consider the company to be worth. So what's market cap? Okay, for those of you who don't know. So market capitalization, sometimes referred to market cap, is the total value of a publicly traded company's outstanding common shares owned by stockholders. So you're talking Tesla, Disney, GameStop, AMC, whatever. If it is a company that's publicly traded and has outstanding common shares and they're owned by stockholders, and they bought them for value, right? These are companies that are listed on the stock exchange. These are not meme stocks, and this is what I was talking about when I read that article to you guys. And some people want to paint it that way because they want to calm down the frenzy and the craze that people are reading on Reddit and then going and buying this stock. Me personally, I am not going to do that. That's market manipulation, I believe, right? Because they're well, it's not market manipulation. It's there's two sides to every coin, right? So average retail investors, Joe Blow on the street, are buying up GameStop in the hopes that hedge funds and the people who had short sold this stock, and this is what we're talking about specifically, are going to be forced to buy back this stock at astronomical prices compared to what we are buying it at because they had short sold it. And we're going to talk about what short selling is. And we as retail investors stand to make a ton of money, right? If you have put a bunch of money in, say you took $1,000 and went and bought 10,000, whatever, of these, these shares in this company, went and bought them. And I'm not saying this is the math that I'm talking about is correct, but say you went and bought them and you're holding them, and then the stock price jumps through the roof, and then you're guaranteed that these hedge funds are going to be forced to come in and buy this stock at astronomical prices. You know, it sounds like you're going to make a lot of money. And if you like money, you wouldn't be mad at that, which most of us do. Okay. So the short selling, and we're going to talk about this specifically. So short selling is a financial practice in which an investor known as a short seller borrows shares and then immediately sells them in the hope that they'll be able to buy them back later, which is called covering, at a lower price, and then return the borrowed shares plus interest to whoever they got them from, to the lender, and profit off the difference. Okay. The practice carries an unlimited risk of losses because there's no inherent limit to how high a stock's price can rise should the short seller be proven wrong in their belief that the stock price was going to fall. This is in contrast with taking a long position, simply owning the stock, where the investor's loss is limited to the cost of their initial investment. Say you bought the stock for $5, you hold it for 20 years. In 20 years, it's not worth $5, it's worth $3. You took a $2 loss over the course of 20 years, right? It might have gone up, whatever, but the price that you bought it at and the price that you sell it at are really the only ones that matter. And that's one of the things I want to impart to you guys, right? That's what value investing is about. You can read a book, I believe it's called The Value Investor. It's written by a guy, Robert Graham. We're talking about Warren Buffett earlier. So Warren Buffett got rich trading and playing in the stock market. The reason why is because his mentor, Robert Graham, is one of the guys that helped create it. And his mentors had helped create markets before. And so, and they wrote these books. And so Warren Buffett has understood how these markets work for a very long time, or how they're supposed to work. And when they aren't working the way that they're supposed to, he capitalizes off of it. Okay. So I find the whole thing funny that this is actually happening with GameStop, which is hilarious. That's where the meme bit of it comes into play, right? Because it's funny and people have made memes, and it's ironic that a company that a lot of, I think, retail investors see as screwing them over when they would go to, turn in their video games for sale or whatever, and giving them a really low price, are basically going to potentially implode the company and the financial system potentially by doing this. So we'll see. That's sort of far-fetched to a degree, but we'll just talk about the facts that matter. Okay. So, when we were talking about short selling and taking a long position, most people take a long position. They buy a stock, they hold it for a certain amount of time, usually a long time, or not most people, but this is your traditional idea of what most people think of what is stock trading, right? You buy a stock and hold it for years or whatever, and it goes up in value. Okay, because it's a good company and you bought the share at a good value, and as the company continues to do well, the stock price reflects that. That's what most people and what most investors expect to happen on a day-to-day basis with the stock market, or the stock market in general, right? Which is not always necessarily the case, because a lot of what I'm trying to fill you guys in on, a lot of what happens in the stock market and in investing in general is you are dealing with people and people's reactions and how they process things, and what's trending and what's not. And it's basically called what's known as investor sentiment, right? So you have a lot of things that go into how much money moves in and out of any given stock or stock market, or market in general, at any given day, time, year, whatever. And most, if not all of that, is based on investor sentiment. Okay. So we'll keep talking about short sellers. So short sellers are exposed to a risk of what's called short squeezing, which occurs when the shorted stock jumps in value because, for instance, there's a sudden piece of favorable news. Short sellers then forced to buy back the stock they'd initially sold in an effort to keep their losses from mounting astronomically. and the market demand they create by purchasing the stock to cover their short positions further raises the price of the shorted stock, thus triggering more short sellers to cover their positions by buying the stock. And this can result in a cascade of stock purchases and an even bigger jump of the share price. Okay, so GameStop, an American chain, brick and mortar video game store that had struggled for years leading up to the short squeeze due to competition from digital distribution services, as well as the economic effects of the COVID-19 pandemic, which reduced the number of people who shopped in person. Okay, as a result, GameStop's price had declined, and leading many institutional investors to believe it would continue falling, thus short selling the stock. Okay. Now, on January 22nd, 2021, approximately 140% of GameStop's public float had been sold short, meaning some shorted shares had been relent and shorted again. And analysts at Goldman Sachs later noted that short interest exceeding 100% of a company's public float had only occurred 15 times in the prior 10 years. However, in mid 2019, investor Michael Burry, which some of you might remember him from, what was that movie? It had Steve Carell in it, and it was about the 2008 housing crisis. I can't think of it off the top of my head. Anyway, Michael Burry's Scion Asset Management acquired a 3.3% stake in GameStop and wrote to the company's board of directors, identifying overlooked value in the company and urging them to buy back shares. And then in August of 2020, Ryan Cohen, the former CEO of online pet food retailer Chewy, revealed a 9% investment in GameStop, leading some to believe that the stock was undervalued. And in January of 2021, Cohen joined GameStop's board, triggering a stock rally. Okay, so the subreddit Wall Street Bets online community on Reddit is known for discussion about meme stocks and high risk stock transactions, right? Stuff that has high volatility when you talk about investor sentiment. Okay. And observers congregating around Wall Street Bets believe the company was being significantly undervalued, and with such a large amount of the stock being short, they could trigger what's called a short squeeze by driving up the price to the point where short sellers had to capitulate and cover their positions at large losses. Now, even before the short squeeze, there'd been an interest in GameStop, which the ticker symbol is GME for those of you who are interested. Keith Gill, known by the Reddit username Deep Fucking Value or DFV, and by the YouTube and Twitter alias Roaring Kitty, purchased around 53,000 in call options on GameStop stock in 2019 and saw his position rise to a value of 48 million by January 27, 2021. Okay, so you're talking over the course of what is that? About 3 years. So Gill's a 34-year-old marketing professional and chartered financial analyst from Massachusetts. He stated that he began investing in GameStop during the summer of 2019 after believing the stock to be undervalued. He shared information regarding his investment on Wall Street Bets, providing regular updates on the investment performances, including times when the investment had plunged. He stated on January 29, 2021, after the GameStop short squeeze, that he thought this trade would be successful, but never expected what happened over the last week, adding that he planned to continue his YouTube channel as Roaring Kitty and potentially buy a house. I'm trying to see if it says anything of value beyond that. Oh yeah. So this had happened. This had happened, and then people started making memes, right? And then there was a popular one where someone had used Chernobyl, which was like a nuclear reactor disaster that had happened in Russia, and had made this meme. And a website published that the subreddit had received 73 million page views in 24 hours, and that broke the all-time traffic records. And then on January 29th, the community surged by 1.5 million users overnight to a total of 6 million users, making it the fastest growing subreddit at the time. So Reddit moderators temporarily closed the subreddit to the public, and Discord moderators temporarily banned the server for hateful and discriminatory content. And apart from GameStop, there were a bunch of other shorted securities that saw increases in their prices. And I'll list them to you guys for those of you who are curious, because they talk about meme stocks, but these are the stocks. So AMC Entertainment Holdings, AMC Networks Incorporated, American Airlines Group, BB Liquidating Inc., Bed Bath and Beyond, BlackBerry Limited, that's the phone company, Build-A-Bear Workshop, Eastman Kodak Company, Express Inc., Fossil Group, Genius Brands International, iRobot Corporation, KOSS, KOSS Corporation, Lingland Pharmaceuticals Incorporated, the Mace Rich Company, Naked Brand Group, National Beverage Corp, Nokia OYJ, Planeteer Technologies Incorporated, Cybert Financial, Tootsie Roll Industries, and then Virgin Galactic Holdings Incorporated. So those are not meme stocks. There's no such thing. Those are real companies, huge companies that are getting talked about. And the hedge funds and others who are short selling these stocks, don't necessarily want you to look into them and join these subreddits and join these communities and get into these get these ideas around it, because you stand to take their money, quite frankly. That's the real deal about it. So that's what's going on. So that happened, and then at one point when these stocks were essentially rallying and going to force this short squeeze, Robinhood and a bunch of other platforms have been alleged to basically stop trading and shut down trading, because it would have forced the hedge funds into bankruptcy, and it would have made everyone who was buying these stocks incredibly rich. So that's probably a discussion that we will continue on a later date. But here's the big news. Okay. So 3 days ago, Roaring Kitty, Keith Gill, post seems to show that he held on to a giant GameStop stake after Monday's rally. So he basically showed that he's still holding, that he has continued to buy this stock. And now it seems that he has doubled down on it, right? And CNBC had released an article, and everyone's talked about how they think that he sold it off and all this other stuff. And then right at the end, at the very bottom, they say, and this is, I'll read you guys the title of this article. It says, who's this by? I don't even know if they even want to put their name on it. So this is on CNBC.com in their market section. It says, and this is a post by a woman by the name of Yun Lee. It's her @ is Yun Lee, YUNLI 626. And this, I don't even know if they even named this article specifically, if they even gave the article a name. But at the bottom of this article, right at the very, very bottom, she notes, Gill's latest post came shortly after this Wall Street Journal report. It appeared to show the trader did not sell, even as the value of his common stake stock alone jumped to 140 million from 115.7 million in a single day. So his position that he hasn't sold went from 115.7 million to $140 million in a single day, and it's expected to continue to climb. So I will leave you guys with that I hope is a good starting point. Please check out what is that movie, Dumb Money, and The Big Short. The Big Short is the movie I'm thinking of, where it talks about the 2008 housing crisis. Please look into that. And you guys will understand maybe a little bit more of what I'm talking about and why this is important and why this is potentially some of the biggest financial news we've ever seen. So I appreciate all my listenership, everyone that tuned in. This episode has gone on for about almost 35 minutes, which is much longer than it usually is, almost double the normal episode time. Thank you for tuning in. I appreciate all of you. Hopefully you guys get value out of this. Please be smart about your money. Save your money, and be informed when it comes to making financial decisions before you just follow someone on Reddit or a subreddit or listen to the news tell you not to. Knowledge is power, and hopefully this, which I hope and feel is the most powerful financial podcast in the world, is of value to you guys. I appreciate those of you who have been watching and following us. Like and follow us on whatever social medias that you're following us on, whether it's Twitter, Instagram, at the Millionaire Millennial Podcast, or following me, stackbanks.official. We appreciate all of it. And our YouTube channel, I believe, is Stack Banks as well. But please, if you can, like, follow, subscribe, share this with a friend, and take care of yourselves. We appreciate your listenership.